Assalamualaikum warahmatullahi taala wabarakatuh. We are from Group Diploma Pengajian Bank and we're going to present to you sir about company ratio analysis from two company, Bermas Auto Berhad and Shanghai Automotive Industry Corporation, or in short SAIC Corporation. Before we further our presentation, I would like to introduce our group members. Myself is NASRUL NAZHAN, and then Muhammad SYAHRIL, Muhammad Haziq, ABDUL and SAPTIYAWAN. As for introduction, we decide to choose two company which is with the nature of business is automotive, and then the company that we choose is one is based on in Malaysia, which is Bermas Auto Berhad, and another one is based in Asia region, which is Shanghai Automotive Industry Corporation. And then AFIQ will be presenting to you sir about the background of the company, and moving on to the graph analysis for Bermas Auto Berhad will be presented by Muhammad Haziq, and for Shanghai Automotive Industry Corporation will be presented by SAPTIYAWAN. And then the presentation will be concluded by Muhammad SYAHRIL with his little conclusion about these two company.
Okay, my name is Abdul bin Abdul Razak. I am going to present about main businesses for both company, Bermas Auto Berhad from Malaysia and SAIC Motor from China. Bermas Auto Berhad is a distributor of Mazda vehicles and spare parts that based in Malaysia. They also distribute a selected range of Mazda vehicles and spare parts in Malaysia and also Philippines. They also operate 3S centers in Malaysia. Mazda is originally a company automotive from Japan. Bermas Auto Berhad Group was listed on the main market of Bursa Malaysia Securities Berhad on 18 November 2013. Bermas Motor Sdn Berhad, a wholly owned subsidiary of Bermas Auto Berhad, commenced operation on 1 April 2008 after Bermas and Mazda Motor Corporation, Mazda Japan, entered into an agreement, that is distribution agreement, on 28 February 2008, in which Mazda Japan awarded Bermas the distributorship of specific models of Mazda CBU vehicles, spare parts, accessories, and tools in Malaysia. SAIC is stand for Shanghai Automotive Industry Corporation Group Corp, or well known as SAIC Motor, is a Chinese state-owned automaker based in Shanghai. SAIC Motor are involved in automotive industry and founded in 1955. SAIC is one of China's three biggest automakers alongside FAW and Dongfeng Motor. SAIC has established joint ventures with major Western automakers, including Volkswagen of Germany and General Motors of the US. In addition to producing and selling foreign brand vehicles in China, SAIC has also focused on the development of its own brand vehicles in recent years, and has a bus and truck manufacturer under its wing. In 1997, SAIC signed a joint venture contract with GM to produce and sell its Chevrolet, Buick, and Cadillac brands. In 2002, SAIC established SAIC GM Wuling Automotive, a joint venture with GM, to increase SAIC's share of the market for small and also cheap commercial vehicles.
Okay, my name is Muhammad Haziq bin Muhammad HUSMADI. I want to present about graph analysis for Bermas Auto Berhad from Malaysia. Liquidity analysis is the ability of a company to satisfy the company's short-term obligations using assets that can be most readily converted into cash. Based on the graph, we can see that current ratio for Bermas Auto Berhad company was up and down for 5 years. The company will facing a problem because a current ratio of less than 1 indicates that the company may have problem meeting its short-term obligations. Next, asset test ratio. It also have ups and downs for 5 years of the company. It shows that a company is struggling to maintain or grow sales, paying their bills too quickly, collecting receivables too slowly, or over leverage. For account receivable turnover, there is also up and down for 5 years. So, an accounts receivable turnover increase means a company is more effectively processing credit in comparison, and accounts receivable turnover decrease means a company is seeing more delinquent clients. For account payable turnover, also there is up and down for 5 years. It shows that a company is taking longer to pay off its suppliers than in previous periods. A decreasing ratio could signal that a company is in financial distress. In inventory turnover, there is decreasing in 2015 to 2017 and increase in 2018 to 2019. Higher inventory turnover ratios are considered a positive indicator of effective inventory management because the company's product is in demand. It could also mean the company initiate an effective advertising campaign or sales promotion that cause a boost in sales. Solvency is the ability of a company to meet its long-term financial obligations. Solvency is essential to staying in business as it demonstrates a company's ability to continue operation in the foreseeable future. While a company also needs liquidity to thrive, liquidity should not be confused with solvency. Based on the graph, a debt ratio less than 1 means that the firm concerned has more assets than liabilities. This measure of debt ratio demonstrates how risky it would be for a provider of debt finance. Next, for interest cover ratio, there is no interest cover ratio for 2 years, which is 2015 and 2016. The company presents less of a risk to investors and creditors in terms of solvency because there is no interest cover ratio for these 2 years. Meanwhile, there is up and down on last 3 years on interest cover ratio means fewer earnings are available to meet interest payments. Failing to meet these obligations could force a company into bankruptcy. Okay, next. Profitability ratios show a company's overall efficiency and performance. Firstly, on gross profit margin for Bermas Auto Berhad, it shown that the company is not efficiently converting revenue into profit, which starts to get less profit per product sold. Other than that, decreasing on gross profit margin also caused when a company fails to make more money on each product it sells. Next, for net profit margin, there is decreasing on 3 years, which are 2015, 2016 and 2017, and increase on 2019. It means that a company use an ineffective cost structure and poor pricing strategies. Therefore, a low ratio can result from inefficient management, high costs, and weak pricing strategies.
Okay, my name is SAPTIYAWAN and I will explain about graph analysis for Shanghai Automotive Industry Corporation Group. The first graph analysis is liquidity analysis, which is liquidity analysis is the ability of a company to satisfy the company's short-term obligation using assets that can be most readily converted into cash. Based on the graph above, we can see that current ratio for SAIC Motor was decreased for the last 5 years, and it shown that the company will facing a problem because their current ratio less than 1 indicate that the company may having a problem meeting its short-term obligation. Next, for acid test ratio, it also decreased for the last 5 years, and it shown that a company is struggling to maintain or growing their sales, paying their bills too quickly, collecting receivable too slowly, or over leverage. Next, for account receivable turnover, there is up and down for 5 years. Simply said, an account receivable turnover increase means a company is more effectively processing credit. And if account receivable turnover decrease, it means a company is seeing more delinquent clients. For account payable turnover is also decreased for the last 5 years, and it's shown that a company is taking longer to pay off its supplier than in previous period. A, a decreasing ratio could signal that a company is in financial distress. Next, in inventory turnover, there is increasing in 2015 until 2019. Higher inventory turnover ratio are considered a positive indicator of effective inventory management because the company's product is in demand. It could also mean the company initiated an effective advertising campaign or sale promotion that caused a boost in sales. Next is solvency analysis. Solvency is the ability of a company to meet its long-term financial obligation. Solvency is essential to staying in a business as it demonstrates a company's ability to continue operation into the foreseeable future. While a company also needs liquidity to thrive, liquidity should not be confused with solvency. Based on the graph above, the ratio is decreasing on 2015 to 2016, and then the growing increase on 2017 until 2019. A high debt ratio is often associated with high risk, and it means that a company has been aggressive in financing their growth with their debt. Next, there is up and down for time interest earned for SAIC Motor on 2015 until 2019. On 2015 until 2017, the company present less of risk to investor and creditor in terms of solvency because there is increasing on-time interest earned ratio for these 3 years. Meanwhile, decreasing on last 2 years, on-time interest earned means fewer earnings are available to meet interest payment. Failing to meet this obligation could force a company into bankruptcy. Last is profitability analysis. Profitability ratio show a company overall efficiency and performance. Firstly is gross profit margin. Gross profit margin for SAIC Motor was decreased in last 5 years. It shown that the company is not efficiently converting revenue into profit, which start to get less profit per product they have sold. Other than that, decreasing on gross profit margin also causes when a company fails to make more money on each product it sells. Next, there is also decreasing on net profit margin for the company in the last 5 years. It means that a company use an effective cost structure or poor pricing strategies. Therefore, a low ratio can result from inefficient management, high costs, and weak pricing strategies.
Okay, my name is Muhammad Syahriil Amin bin Muhammad Syam. I am going to present to you the conclusion of our assignment.
In a nutshell, both companies are not doing well. This means that both companies need to improve their skill if both companies want to continue their business before they get more loss. Both companies need to submit an initial invoice for liquidity ratios. This means immediately submitting your invoice to the customer. This is because the bigger your account receivable increase and the faster you earn money for your sales, the better your current ratio will look and you will earn enough money. Second, both business need to turn to long-term debt instead of short-term debt. This is because you get the advantage of smaller monthly payment and lower interest rate than long-term debt. Finally, both companies need to control their overhead. This means how much you spend on rent, labor, professional fees, marketing, and etc. Next, for solvency ratio, it shows us that both companies are not good and settle all their debt. This is because we can see in our analysis that both companies can only settle their debt by less than 50% in 1 year. Therefore, this causes their debt to grow each year. If both companies do not improve their performance, this may cause stockholders to take back their share from these companies. Finally, for interest cover ratio, Burma's Autobahn are always consistent, meanwhile Side Motor did not stable their performance in interest cover. Lastly, for both companies, profitability ratio, it shows us that both companies isn't efficiently converting revenue into profit with start to get less profit per product sold. Other than that, decreasing on gross profit margin also cause when a company fail to make more money on each product itself. Finally, decreasing in net profit margin, we can see both companies use an ineffective cost structure and poor pricing strategies. Therefore, a low ratio can result from inefficient, high cost, and weak pricing strategies. Thank you.
Thank you for lending us your ears and attention. Assalamualaikum warahmatullahi wabarakatuh.